North American agriculture in the mid-2020s is a tale of two fortunes, unfolding across the vast fields and rural communities of the continent. While both the United States and Canada share similar landscapes and climates, their agricultural realities have sharply diverged in recent years. American farmers are facing economic turbulence. Falling crop prices and volatile incomes have left many squeezed. The cost of production continues to rise, while the prices they receive for their crops have plummeted, putting immense pressure on family farms and small operations. After record highs in 2022, the U.S. farm economy has sharply declined, wiping out billions and shaking rural communities. Once thriving towns are now dotted with shuttered businesses and empty storefronts, as the ripple effects of the downturn spread far beyond the fields. Meanwhile, Canadian farmers are thriving, posting record-breaking cash receipts and enjoying a period of prosperity. Investments in technology and infrastructure have paid off, and many Canadian producers are expanding their operations, hiring more workers, and upgrading equipment. This contrast is driven by global market dynamics, trade agreements, currency shifts, and domestic policies. Canada's favorable trade deals and a weaker currency have boosted exports, while American farmers face stiffer competition and less favorable terms abroad. For Americans, the pain comes from steep drops in crop values. Corn and soybeans have lost much of their previous gains. Storage bins are full, but buyers are scarce, and many worry about how long they can hold out. Increased global competition and softening demand have only made things worse. New players in the global market, from South America to Eastern Europe, are capturing market share, leaving U.S. farmers with fewer options and lower prices. While livestock has offered some relief, the overall trend is contraction and uncertainty, forcing tough decisions for U.S. farmers. Many are selling off herds, delaying equipment purchases, or even leaving agriculture altogether. The economic divide has become a political flashpoint, raising questions about trade, competitiveness, and the future of the American heartland. Rural voices are demanding answers and action from policymakers as the stakes for their communities grow ever higher. When figures like Donald Trump weigh in, the issue explodes into national news, symbolizing the anxiety and frustration of rural America. The debate over farm policy, trade, and rural prosperity is far from over, and its outcome will shape the future of North American agriculture for years to come. The USDA's 2024 forecast was a wake-up call for the entire agricultural sector, sending shockwaves through rural communities and farm households across the country. According to the report, net farm income was set to drop by $41.20 billion, a staggering 22.6% plunge from 2022's peak. This isn't just a number, it represents the livelihoods of thousands of families and the economic backbone of many small towns. This volatility has left farm families on edge, with net cash farm income also tightening. Many are finding it harder than ever to fund daily operations, pay off loans, or invest in new equipment. The uncertainty is palpable, and the stress is mounting as bills pile up and margins shrink. The main culprit? A sharp fall in crop receipts which has overshadowed any positive trends elsewhere in the sector. Lower prices for key commodities like corn and soybeans have hit farmers hard, erasing gains from previous years. Looking ahead, a 2025 forecast predicted a 30% rebound in net farm income, but this recovery is driven almost entirely by a massive increase in government payments, not by a true market turnaround. This growing reliance on federal aid exposes the sector's vulnerability and raises tough questions about its long-term health and independence. Many worry that the industry is becoming too dependent on government support to survive. Even with the projected rebound, farm incomes remain well below 2022 highs, and uncertainty continues to cloud investment decisions. Farmers and investors alike are hesitant to commit to new projects or upgrades, unsure if the safety net will hold. The farm economy now swings between extremes, with government payments smoothing out the worst dips but failing to provide lasting stability. This roller coaster effect makes it difficult for families to plan for the future. This cycle of crisis and rescue signals a system under strain, where market forces alone can't guarantee stability. The constant threat of financial distress has led to more farm auctions and bailouts, highlighting the fragility of the current model. Farmers are left navigating a landscape where profitability is increasingly tied to policy decisions, not just production or efficiency. The rules of the game are changing, and adaptability is more important than ever. The future of U.S. agriculture depends on breaking this cycle and restoring true market-driven growth. so that farmers can thrive on their own terms and rural communities can look forward to a more stable tomorrow. The crop sector is at the heart of the U.S. farm downturn, and nowhere is this more evident than in the corn and soybean markets. These two crops are the backbone of American agriculture, supporting not just farmers, but entire rural communities and countless related industries. After a decade of strong prices and optimism, the tide has turned. The sector now faces a sharp reversal, with crop receipts projected to fall by $25 billion in 2024, the second consecutive year of decline, and a worrying sign for the future. Farmers are feeling the squeeze as input costs remain high, but the prices they receive for their crops continue to drop. This financial pressure is forcing many to make tough decisions about their operations. Weaker global demand, especially from China, and fierce competition from Brazil and Argentina have battered corn and soybean markets. These countries are producing record harvests, flooding the market and driving prices even lower. Corn receipts alone are set to drop by over $16 billion, a staggering loss for producers who rely on this staple crop for their livelihoods. Soybean revenues are expected to fall by nearly $7 billion, an equally devastating blow, especially for family farms that have little margin for error. When prices fall below the cost of production, the pain ripples outward. Entire rural economies feel the impact, from local businesses to schools and healthcare providers. The USDA expects further declines in 2025, signaling a new reality of persistent low prices. Other crops like cotton are also under pressure, with many fields showing signs of stress. Sugarcane is struggling as well, broadening the distress and making it clear that this downturn is not limited to just a few crops. To cope, farmers are dipping into savings, taking on more debt, and in some cases selling off equipment or land just to stay afloat. Many are rethinking their strategies, exploring new crops or technologies, and searching for ways to survive as the era of high commodity prices fades into memory. Navigating lower revenues and high costs is now the central challenge for American producers, and the road ahead looks uncertain for many farm families. Livestock initially looked like a bright spot, with 2024 receipts projected to rise by $21 billion. Eggs and dairy led the way, with egg receipts surging nearly 40% due to avian flu disruptions, and milk up by $5.3 billion. Cattle receipts also climbed, thanks to tight supplies and strong beef demand. But not all was well. Turkey revenues collapsed by 43%, showing volatility even in strong sectors. Looking to 2025, livestock growth is expected to slow, with some markets declining. The sector's patchwork of winners and losers means it can't offset the crop slump alone. Even in areas of strength, risks and market swings threaten profitability. The livestock story is one of complexity. Successes are real, but so are the underlying troubles. While revenues have swung wildly, production costs remain stubbornly high. Slight decreases in expenses for 2024 and 2025 offer little relief after years of inflation. Fertilizer, fuel, and feed costs have eased, but not enough to offset record-high expenses elsewhere. Labor and livestock procurement costs have hit new peaks, erasing any savings from cheaper inputs. The result, a classic cost-price squeeze, with profit margins razor-thin. Working capital has declined, signaling eroding financial cushions for farms. Even with minor improvements forecast, the pressure remains intense. Managing costs is now as critical as chasing higher prices. For many, survival depends on relentless efficiency and tough financial decisions. Direct government payments have become a lifeline for U.S. farmers. In 2024, payments dipped slightly, exposing farmers to harsher market realities. But in 2025, a projected surge to $42.40 billion, mostly from ad hoc disaster aid, will prop up farm incomes. This isn't driven by traditional safety nets, but by emergency relief tied to weather and other crises. The scale of these payments highlights the sector's dependence on government rescue, not market strength. Farmers can't plan for the future based on unpredictable bailouts. The system now relies on emergency aid, masking deeper structural problems. The 2025 rebound is less a recovery than a government-funded rescue. This fragility sets the stage for heated debates about the future of farm policy and taxpayer support. While U.S. farmers struggle, Canada's agricultural sector is booming. Canadian farm cash receipts have soared past $100 billion, with both crops and livestock driving growth. Strong global demand for canola and wheat, a weaker Canadian dollar, and a reputation for quality have boosted exports. This currency advantage gives Canadian products a competitive edge that U.S. farmers lack. Canada's focus on key commodities and effective trade agreements has built a resilient, profitable industry. The livestock sector is thriving too, with strong returns in cattle and hogs. Optimism prevails among Canadian farmers, a stark contrast to U.S. anxiety. While U.S. farm income relies on government aid, Canada's is driven by market returns. The divergence is striking and troubling for American policymakers. It forces tough questions about U.S. competitiveness and support systems. As Canada thrives, the U.S. must rethink its strategy to keep pace. The U.S.-Canada farm divide exploded into politics when Donald Trump took to primetime TV. He blamed falling U.S. farm incomes on weak trade policies, claiming Canada was eating our lunch. Trump's rhetoric resonated with rural audiences, turning economic pain into a rallying cry for tougher trade. His remarks ignited debate, pressuring politicians to respond and making farm policy a central issue. For many farmers, Trump's words validated their frustrations and focused their anger. The simple narrative, America losing out to Canada, cut through the complexity. The fallout ensured that farm income and trade would dominate the political agenda. Declining revenues, high costs, and reliance on government aid have created deep uncertainty for U.S. agriculture. Farmers now plan for the next season with market prices depressed and profitability tied to federal payments. This short-term focus discourages investment in innovation and sustainability. Canada's success highlights the need for diversified markets, smart trade, and a competitive edge. U.S. farmers must focus on efficiency, risk management, and possibly new crops to survive. Financial stress may accelerate farm consolidation, reshaping rural America. Yet, American farmers are resilient. Adaptation and innovation are in their DNA. The challenge now is for policymakers to move beyond quick fixes and craft a vision that restores market-driven profitability and secures the future of American agriculture.